While financial markets focused on Federal Reserve policy and tech stocks, something remarkable happened in the physical commodities market. Recent trade data reveals a supply-demand shift in silver that warrants serious attention from investors and industry observers alike. The numbers tell a compelling story. India imported approximately $5.9 billion worth of silver in just 4 months. To put this in perspective, India's average annual silver imports from 2013-2019 were roughly $1.5 billion for the entire year. We're looking at a 400% year-over-year increase in import volume. This isn't gradual growth, this is a structural shift in demand patterns. Let's examine what's driving this unprecedented buying. India is in the midst of massive infrastructure modernization. The country is building extensive solar capacity as part of its renewable energy goals. Solar photovoltaic cells require significant amounts of silver for their conductive properties. Additionally, India's growing electronics manufacturing sector, positioning itself as an alternative to Chinese production, requires silver for various components. The timing of these imports aligns with India's industrial expansion timeline, suggesting this isn't speculative buying. It's strategic stockpiling by industries that need physical metal for production. India has a cultural affinity for precious metals as stores of value. However, the scale of these imports exceeds traditional jewelry and investment demand. The Nifty Metal Index in India is showing its strongest performance relative to the broader market in over a decade, indicating that institutional investors are rotating capital toward commodity-exposed equities. This suggests a macro shift in how Indian capital allocates between paper assets and hard assets. Recent reports indicate significant premiums for silver in Shanghai compared to London and New York prices. While exact figures vary by source and timing, premiums of several dollars per ounce have been observed. Price premiums in one market versus another indicate supply constraints or delivery frictions. When premiums persist and expand, they signal physical delivery bottlenecks, strong local demand that cannot be satisfied by current supply chains, and potential regulatory or logistical barriers to arbitrage. During previous silver market tightness in 2011, Shanghai premiums reached elevated levels. Current premiums suggest similar or potentially greater market stress, though it's important to note that market conditions differ significantly from 2011. The key question: are these premiums temporary or structural? China has been implementing various export controls on critical materials, and there are indications that refined silver may face restrictions. From China's perspective, this policy makes economic sense. China is the world's largest manufacturer of solar panels and electronics. These industries require silver as an essential input. Exporting raw silver only to import finished goods doesn't capture value add. By restricting raw material exports while encouraging finished goods exports, China keeps more value within its borders. This is standard industrial policy, similar to how oil-producing nations prefer to export refined products rather than crude. If major refining capacity is located in regions restricting exports, this creates supply challenges for markets like the COMEX and LBMA that rely on global flows to balance supply and demand. This fragmentation of markets is significant. We may be moving from a truly global silver market to regional markets with different pricing structures. The current trade environment adds another layer of complexity. Trade barriers increase costs by definition. If silver refined in one country faces tariffs entering another, the effective price rises. If multiple countries implement protective measures simultaneously, global flows become less efficient. This isn't necessarily bullish or bearish for silver. It's structurally inflationary. It raises the cost of doing business across borders. When investors anticipate persistent inflation and supply constraints, they historically rotate toward commodity-linked assets. The performance of mining stocks in India and elsewhere suggests this rotation may be underway. The Nifty Metal Index's 11-year high relative to the broader Indian market is noteworthy. It suggests institutional capital is positioning for a commodity-favorable environment. Silver recently tested significant resistance levels, with prices reaching multi-year highs. Round numbers matter in markets because they trigger behavioral responses. If silver approaches $100 per ounce, media coverage will intensify dramatically, retail participation will likely increase, and volatility will probably spike. This creates both opportunity and risk. Increased participation means increased liquidity, but also increased speculation and potential for sharp reversals. The divergence between futures markets and physical delivery markets is widening. Premiums at retail dealers are significantly above spot prices. This spread indicates delivery friction exists in the system. Physical buyers are willing to pay significantly above paper prices, and the futures market may not be accurately pricing physical supply tightness. For industrial users, supply security may require paying premiums or securing long-term contracts. Just-in-time inventory strategies may face challenges. For investors, physical holdings provide delivery certainty but carry storage costs and premiums. Paper exposure offers liquidity but may not track physical prices during stress. For speculators, volatility creates trading opportunities but also significant downside risk, especially with leveraged positions. If supply constraints prove structural rather than temporary, and if industrial demand continues growing with renewable energy expansion, silver could see sustained higher prices. The combination of supply inelasticity, silver mining has long lead times, and rising demand creates a fundamental imbalance that takes years to resolve. But high prices cure high prices. If silver reaches levels that make substitution economically viable, industrial users will find alternatives. Additionally, if economic growth slows, industrial demand could decline. Speculative froth can deflate rapidly when momentum traders exit. The most likely scenario is continued volatility with an upward bias, driven by structural supply challenges partially offset by demand destruction at extreme prices. Regional price disparities may persist as markets remain fragmented. If you're considering silver exposure, understand what you own. Physical metal, ETFs, mining stocks, and futures all behave differently under stress. Don't chase the market. The worst investments are often made at emotional extremes. If you're buying because of fear of missing out, reconsider. Position size matters. Commodities are volatile, so size positions accordingly within a diversified portfolio. Watch the fundamentals. Track actual supply-demand data, not just price action. Monitor industrial demand indicators, mine production, and inventory levels. Premiums are real costs. If buying physical, factor in both the purchase premium and eventual sale discount. If you already hold silver, define your thesis. Are you hedging currency risk, speculating on supply shortage, holding for industrial use? Your timeline and strategy should match your thesis. Monitor invalidation signals. What data would make you reconsider? Set mental stop losses based on fundamentals, not just price. Consider scaling. Taking partial profits into strength while maintaining core positions can reduce emotional decision-making during volatility. The data points we've examined, India's import surge, Shanghai premiums, export restrictions, commodity equity performance, are all verifiable and significant. What they mean for silver's future price is less certain. Markets are complex systems where multiple forces interact. Supply constraints are real, but so is the capacity for demand destruction and substitution. Policy can change rapidly, macroeconomic conditions can shift. What we can say with confidence: the physical silver market is experiencing stress. Regional markets are fragmenting. Industrial users face supply chain challenges. Price volatility is likely to continue. For investors and industry participants, this environment requires heightened attention to fundamentals, careful position sizing, and clear strategy. The silver market is telling us something important about resource scarcity, industrial policy, and monetary uncertainty. Whether it's telling us that silver will reach 150 or correct back to 60 is a different question, one that will be answered by time and market forces, not by certainty or hyperbole. Stay informed, stay disciplined, stay solvent. This analysis is for informational purposes only and does not constitute financial advice. Commodity markets carry substantial risk. Past performance does not guarantee future results. Conduct your own research and consult with financial professionals before making investment decisions.